Okay, let's go ahead and go through the solution to the question on using the cost method to account for our investment. So again, here's our problem. We need to copy and paste as values. And maybe a little editing would help. There we go. Okay, and for some reason, occasionally I get this sort of wonky cursor, but we'll see what I can do. Okay, so here's our information. We've got a big company acquiring 55% of little company's voting stock for $246,589. The fair value of the non-controlling interest is given. All this stuff is given there. We assume that big uses the cost method to account for their investment. Prepare the necessary elimination entries for 2020 and 2021. Okay, so again, first we need to do is go ahead and go through our differential analysis. So the fair value of the investment, we have the cost of Big's share plus the value of the non-controlling interest, total that. Subtract out the book value, and that gives us our differential. Okay, so we have a 71,422 differential. What explains that? Little's property, plant, equipment net, so there's no separate accumulated depreciation, was undervalued by 37,197. So the remainder is goodwill. Okay, and the property, plant, equipment is going to be amortized over 5 years. So there's our annual amortization. Okay, let's go ahead and go through our elimination entries. First, we eliminate the subsidiaries' beginning of year 1 equity accounts, common stock. And I'll get all those values are right there on the side there. Retained earnings. We're going to go ahead and record that property, plant, equipment net. I'll use that one instead over there. Goodwill. What else do we have? Okay, that's that. Investment. Is going to be the cost of the investment. And we have the non-controlling interest for the fair value of the non-controlling interest. Okay, and again, nice little check figure built in here. Basically, that plus that plus that plus that. Debits equal credits, so everything's right with the world there. Okay, A for amortization. Depreciation expense, I've already calculated the annual amortization right there. And since we're not using a separate accumulated depreciation account, we'll do property, plant, equipment net. Under the cost method, we combine the investment income and dividend entries, and so we're going to go ahead and eliminate investment income. Now again, if big company is using the cost method, their investment income is going to be their share, 55%. Of Little's dividends for that year. So dividends in year 1, 22,311. Okay. The balance of that accrues to the non-controlling interest. And that's going to be our dividends declared. Okay, and then lastly, the income to the non-controlling interest. That's going to be the non-controlling interest's share, 45%, of Little's adjusted earnings. So their reported earnings were $59,318 minus their amortization equals. And that's going to be the non-controlling interest. Okay, so there's year 1, whatever, 2020. And now let's go ahead and do 2021. And again, I'm going to go ahead and be lazy, and it's going to be the same entries, just different numbers, or largely the same entries. There's going to be some additions. I'm just going to copy that over there. And again, what have we got? Common stock, didn't copy the values. Common stock is going to be as it was before. Retained earnings, now Lidl's retained earnings. Last year their retained earnings were $321,889.60. We add their income for 2020, we subtract their dividends for 2020, and so their end of 2020, beginning of 2021 retained earnings are 350, and let's go and format these to be numbers. Take 2 decimal places. Okay. Property, plant, equipment net, we created a differential of 37,197, and then we amortized or took away 74,39, so that's left there. Goodwill is the same as it was before. Now again, this total here, 477, 911, 24, we're going to go ahead, let me make some more room here. We're going to go ahead and give the non-controlling interest their share, 45% of that total. That part's the same as it was before. For the parent's share, the parent would get the other 55% of that, or 262,851.18. Now the problem is not really a problem. Their investment account is stuck at its original cost of that, 246,589. We want to allocate to them 262,851. The additional, what's the difference there? The additional 246 to 262. The other 15,000 and some odd dollars is going to be adjustment to retained earnings. That minus that. Basically it's a plug figure to make this entry balance. Depreciation expense, just like it was before. Investment income, the parent's share of Lidl's 2021 dividends. The non-controlling interests share, their share, 45% of the 2021 dividends. And dividends declared. Oops. And finally, the income to the non-controlling interest. And again, they're going to get their share, 45%, of the subsidiaries' adjusted earnings. We're going to go ahead and take the subsidiaries' reported 2021 earnings, subtract out the depreciation adjustment, and so. Okay, so income to the non-controlling interest, $18,162.72.